Okay, this is a problem on gain or loss calculation, and the first thing we want to do is enter the market value, and it looks like we received 19,000 of cash, and then the cost of this equipment when we purchased it was 33,000, and the accumulated depreciation is 12,000. So the book value is 33 minus 12,000, which would be 21,000. So it looks like we received less than the book value, so we are going to have a $2,000 loss. Now, to record this, we received cash, so we will debit cash for 19,000. And we're going to take the cost of the equipment and the accumulated depreciation off. The normal balance of equipment is a debit, so we will credit equipment. The normal balance of accumulated depreciation is a credit, so we're going to debit accumulated depreciation for 12,000. And we have a loss of 2,000, and a loss would be right here. Losses are recorded as debits, and then we have to take the equipment off for the let's see, 33,000. Check and make sure that your total debits equal your total credits, and we sold equipment for cash. For the next one, it says Love sold clothing consignment for fixtures for 14,000. The useful life is 5 years, and it's the double declining balance with 0 residual value. And it looks like we sold these on October 31st for 8,200. The depreciation, we want to record it for 2018 and the sale of 2018. So first of all, we're going to use the double declining balance. So we're going to take the cost, and we're going to times that by 1/5, which is the number of years. 1/5 times 2, which would be 2/5, so times 2 divided by 5. So depreciation for the first year was 5,600. Now to get depreciation for the second year, you have to take the book value, which would be the cost minus accumulated depreciation, which we just figured was 5,600. So now our book value is 8,400. So we want to times that by 2/5, and that would be 3,360. But we only want to go from January to October, the end of October, so that would be 10 out of 12 months. So we need to record depreciation for this year of 2,800. To record the depreciation. The market value that we received 8,200 cash. The cost was 14,000. That's how much we purchased it for. The accumulated depreciation is the 2,800 up here plus the 5,600 of the first year, so 8,400 would be accumulated depreciation, and 14,000 minus 8,400 is 5,600. So it looks like we have we received more than the book value, so we have a gain of $2,600. And then to record the sale, we received cash of $8,200. We take the accumulated depreciation off by debiting it, and we take the equipment off, which was fixtures, sorry, not equipment, of $14,000. And then we have to record a gain. Gain is a credit. So the gain was $2,600, and I left a zero. So $16,600 to for the sale of fixtures for cash. Now question 4, this is minerals, so we're going to purchase the minerals for cash, and I believe it was $762,300. $762,300 to record purchase of minerals. Then the payment of fees, that's still going to be part of our minerals. And the payment of fees was $800 plus $1,900, which would be $2,700 plus $60,000. So $62,700, $62,700, and this is to record to record the payment of costs associated with purchased minerals. Then the depletion for the first year. So what we need to do is we need to take the total cost, which is the $62,700 plus the $762,300, and we get $825,000 minus the residual value, which is 0, divided by $550,000. So if you divide by 550,000, you get 150 per ton. So we're going to record our depletion. So it's 150 a ton, and we removed 40,000 tons. So 40,000 times $1.50 would be 60,000 of depletion for the first year to record depletion. Now for amortization of a patent, we paid $600,000 for the patent. We're going to record the purchase of the patent for $600,000. Then we're going to record amortization for the first year, and amortization is just straight line, and it's $600,000 divided by 600,000 divided by 10, because that is our useful life, and it's 60,000. And we're going to record amortization expense. We're not going to credit accumulated amortization. We're just going to credit the actual patent itself for 60,000. And this is to record the amortization. And then it says that after using the patent for 5 years, that it's only going to last us on the basis starting with year 6 to amortize the remaining cost of the patent over the 2 years remaining. So we've used up 5 years, so 60,000 times 5 is 300,000. Well, the cost was 600,000, so we have 300,000 left to amortize in 2 years, so divide that by 2. So we're going to amortize 150,000 for the next 2 years to get the value down to 0 at the end. So this is to record the amortization. Now for this last question, it's goodwill. So that we purchased another business for $12 million cash, And the market value of the assets, we don't care about the book value when we're doing goodwill. The market value of the assets that we're purchasing is $16 million. And the market value of the liabilities we are purchasing is $15 million. So the market value of the net assets is 16 minus 15, which would be $1 million. And let me make sure that I put all that in right. So $1 million. So we purchased it for $12 million. So we have goodwill of $11 million. Hopefully I put all the zeros in right. Then we're going to record it. So we got assets of $16 million. That was the market value. And we got liabilities of $15 million. And let's see, assets minus liabilities would be $1 million. So, and we paid cash of $12 million. So we need to record the asset goodwill for the $11 million. Goodwill is an asset. And this is to record the purchase of the company. And that is all of homework chapter 9.